Hello learners, today in the session I will be teaching you the derivative market and introduction. Before this lecture you already have learned the debt market, the debt securities. As you already know that in the capital market both shares, debentures, stock indices etc. are transacted. Debt securities are very important. Today I will be telling you about the derivative market. As you already know that derivative market are derived from the securities market which deals in shares and debentures. The main objective of this session is to understand the structure of financial markets and derivative markets. You will also understand the meaning and features of derivatives. You will be enabled to learn what type of participants actually play their role in derivative markets. You will also learn the basics of forwards, futures, options and swaps in the derivative markets. As you already know that financial markets deals in different types of securities, and it is the same just like commodity markets. Commodity markets deals in different types of commodities. Financial markets are the places where shares and debentures are bought and sold. This market is divided into two parts. The first is primary market, which deals in the new issue of shares and debentures, whereas in the secondary market we deal in different types of securities which are already issued. This is also called the capital market or the stock market. This stock market is again divided into spot market and derivative markets. In the spot market, cash transactions are transacted, whereas in the commodity, in the derivative markets, different types of derivatives are transacted. Derivatives are of normally four types. Number one, forwards. Number two, futures. Number three, options. And number four, swaps. Now, what is derivative market? A derivative market are subset of financial markets and commodity markets. In both the markets, derivative market present. Derivative market does not actually deals in the primary securities like shares and debentures, but it deals in different types of derivative markets which have their value in the underlying assets like shares and debentures, indices, etc. Derivatives are either traded bilaterally between two parties or between contracting parties at the uh, exchange platform or over the uh, transaction over the counter trade. This is the OTC, this is called the OTC market. This market is generally unregulated. Basically, stock trading in India has been floor based activity, but now this activity has been online. You can online transact in these stock exchanges through your websites, through the websites of the exchanges. In this online trade, companies actually acts as stock brokers for the investors in online exchanges. Now the question is, what are derivatives? Derivatives are actually contracts between two parties to buy or sell specified quantity of commodity at any future date and at certain price agreed upon by them on the value of underlying assets. Underlying assets means shares and debentures, stock indices, and commodities. Hedging again is the activity which is derivative performs. Actually, the transactions in shares and debentures have a lot of risk, and this risk exposure can be hedged by the use of derivatives. So, the buyer and seller enter into a contract into any exchange which is regulated. The main property is that these types of derivative contracts are not obligatory. If these are advantageous to you, then you can transact or exercise your contract, otherwise not. Trading will be in derivatives or futures. It will not be in the primary securities like shares and debentures. Trading in equity futures are quite similar as commodity futures trading. A derivative is a financial contract between two parties, A and B, to buy or sell. One can buy and other can sell an asset any future date on agreed price and place. For example, if you have some shares of any company and the current share price is 130, there is a risk before you. Either the share prices may rise or share prices may fall. Then what is the alternative before you? The main alternative, the one alternative you have, is that you can buy an option at a strike price of rupees 125. Strike price means the price which you can take in the future. This is the decided price for the future. If share prices rises, then you will earn the profit. For example, share prices rise to 150 and the strike price is 125, you will get 25 as profit. But if share prices are down by down from 125, then your loss will be only premium. What you have to pay is the premium. Premium is the price for buying the derivative contract, because derivative contracts are not free. Derivative have some characteristics like derivatives do not have any physical existence except the contract between two parties. So the settlement of transaction are made by payment of differences in cash and not by transacting physical assets. The differential in prices can be paid either in cash or by the transfer of physical assets. Both can be there. Derivatives are closely associated with their underlying assets like shares and debentures, indices, etc. And their values are affected by any change in the value of underlying assets. Derivatives traded in exchanges are liquid. Liquid means it can be transferred from one party to the another and transaction can easily be effected. So you can have money liquid in your hands and you can use that money. Derivative demand relatively lower margins. The price of buying or selling the derivatives is very less. You have to pay the margin. Margin are very less. The derivatives markets are usually online, unlike trading markets for physical assets. Derivatives are not free. but involve a cost like premium payment by buyer to writer in case of buying option rights. Derivatives are tools to avoid or reduce risk and used as risk hedging. It means you can lock prices today for the future, and, and if it is advantageous to you, you can exercise your contract and get the profit. Otherwise, you will have only cost as premium. Now question is, how many participants in derivative markets? What is their role in derivative markets? First are hedgers. Hedging is used to reduce risk through derivatives. Hedgers use options to protect against price movement while benefiting from favorable price movements. They are actually the risk transferers who transfer the risk in exchange of premium, which is paid from buyer to seller. Speculators are other participants who use these futures and options in exchange of the minimum price, which is premium, which is paid to them by the buyer. Arbitrators are actually the persons or the participants who benefits on the price differentials between two markets. They are simultaneously dealing in two markets and they benefit from the price differentials. They lock in riskless profit by simultaneously entering into transaction in these markets. Financial derivatives are of four types: forwards, future, options, and swaps. Forwards are again classified into two categories. The first is spot delivery. It means the transfer of assets is to be done through physical delivery, and this delivery is for cash. In the future delivery, delivery is to be given at any future date and the payment will be done also in the future date. The most important benefit of derivatives is that you don't have to deal in cash or delivery at present, but in the future you can postpone it for the future. Forwards are contracts made at present between two parties but implemented at future date. Both parties decide date, price and quantity at contract date. For example, a wheat growing farmer is worried about future prices of wheat. So, in order to avoid risk exposure, he enter into a forward contract with a trader to sell 10 quintals of wheat at rupees 3000 per quintal. 3 months on a specified date to be implemented on a specified date after 3 months by actual delivery. For example, the prices of wheat which are today 3000, if it is increased to rupees 3100, the seller has to suffer a loss of 100 for each quintal or rupees 1000 for the whole deal, and his loss would be buyer's profit. The buyer will be benefited. The buyer can exercise his contract at 3000 and he will get a profit of 100 for each quintal, that is 1000 for the whole deal. It can be explained in this diagram easily. You can see that the contract price is 3000. If the prices are down, the at the maturity date, which is rupees 2,900, at this lesser price, the buyer will get the profit of 1,000. On the contrary, if the maturity price increases at rupees 2 rupees 3,100, it will be the loss of the buyer. But this type of contract has to be physically settled, and the actual delivery has to be given. Essential feature of a forward contract is that these are bilateral between two parties. These are customized. You can decide anything between two parties, whatever they agree. These contracts are obligatory. Physical delivery and cash payment is necessary. These are not transferable, and these are not traded at any exchange. On the other hand, there are futures. Futures are almost same as forwards, but they serve the same purpose. However, future contracts are forward contracts in terms of that they are standardized. It means the lot size is decided by the exchange and it is uniform. The method of operation is also uniform, and these can be transferred before the expiry or at the expiry date, and the implementation of contract can be done by physical settlement or the payment of differentials. As you can see, forward and futures are different in terms that forwards are customized but futures are standardized. Forwards requires physical delivery and cash payment, whereas in futures you can wait till maturity and then make delivery. Forwards are transferable. Forwards cannot be transferable, but on the other hand, futures are transferable. Forwards are not traded at any exchange, any regulated exchange, but on the other hand, the future are traded in organized exchanges. Then the next category is options. I will deal with these options in the part B of this lecture, this session. You have already understood what is derivative market, what is the meaning and features of derivatives. You have also learned what are the main participants of the derivative market, and you also have learned that there are 4 types of basic derivatives: forwards, futures, options and swaps. In the part B, I am telling you the options and swaps. Thank you.